In the cryptocurrency ecosystem, dormant wallets operate a lot like sunken treasure ships. They are massive, untouched stores of wealth resting quietly at the bottom of the public ledger, rarely surfacing. The focus of our investigation is a specific blockchain address known to trackers as 18TEXP. For over 12 straight years, not a single digital coin moved in or out of this particular address. During its last period of activity more than a decade ago, this wallet held exactly 500 Bitcoin. Back then, that cash was worth roughly $500,000. A 12-year silence from an address like this draws intense scrutiny from market analysts. It points to a very early adopter who was held through multiple market cycles, letting those original assets appreciate into a fortune. Then, without warning, the wallet woke up. Every single one of those 500 Bitcoins was suddenly transferred out of the 18TEXP address. The public nature of the blockchain means you can't move that kind of money quietly. Automated on-chain tracking platforms like Whale Alert and Lookonchain instantly flagged the massive transaction, broadcasting the activity to the entire market. When a whale account of this size awakens, analysts immediately look for one of two motives. The owner is either moving the funds to cash out in a massive market sell-off, or they are executing a highly secure internal migration to a new storage setup. The blockchain's hyper-transparent ledger ensures everyone can see the money move in real time. But because it doesn't reveal the owner's true financial intentions, these sudden transfers easily trigger immediate market panic. To figure out why 18TX finally moved its assets, we have to look at what was happening in the broader crypto industry in the days right before the transfer. The market had just been rattled by the cold card security incident, a scare that raised serious concerns over the safety of physical hardware storage devices. Many early adopters rely on a practice called self-custody. Instead of trusting a third-party exchange like Coinbase to hold their funds, they manage their own cryptographic keys offline, usually on dedicated USB-like devices. The cold card incident sparked intense debate. It forced long-term holders to urgently audit their own offline setups to make sure their devices hadn't developed vulnerabilities over the years. Look at the timeline and the picture gets clearer. The 500 BTC transfer happened right in the wake of this hardware scare, pointing heavily toward a defensive security update rather than a rush to cash out. Former Binance CEO Changpeng Zhao addressed this exact self-custody market panic head-on. Zhao warned the community that no single storage solution or hardware wallet is permanently immune to vulnerabilities. Technology degrades and hacking methods improve. His recommendation for investors was active risk management. Rather than locking digital wealth in one static vault for years, he urged users to diversify their storage methods across multiple secure environments. The threat landscape has evolved. Keeping crypto assets untouched and entirely unmonitored for over a decade is no longer a viable strategy. Returning to the 18TXP investigation, analysts still needed hard proof to confirm if the owner actually intended to sell the 500 Bitcoin. This topological flowchart illustrates how analysts confirm a sale. The original wallet node can branch to a centralized exchange for liquidation or to unknown private storage. Current data shows a clear path. The funds kept strictly on the private side of the ledger. Because there is zero exchange interaction, market analysts can effectively confirm this movement was a routine security protocol. It was a massive custody shift, not a market dump. Large on-chain transfers consistently generate terrifying headlines. But as this forensic trail shows, the reality is often just a mundane change in custody. This is the ongoing paradox of the blockchain. We have a public ledger where every single transaction is visible for the world to dissect, but the underlying strategic motives of the people making those massive transactions remain completely hidden from the public eye. Securing an asset that has appreciated this aggressively over a dozen years requires constant vigilance. Self-custody is not a passive set-and-forget action. It is an active, lifelong responsibility driven by a necessary, constant technological paranoia.